You know, when you think about a traditional bank vault, there's this expectation of heavy physical friction, right? Like steel doors, complex combinations, armed
Right.
guards.
Yeah. It's intentionally difficult.
Exactly. It's physically hard to get the money out.
It is, yeah. It's a physical fortress, which naturally creates a psychological fortress in our minds. Historically, I mean, we've liked our money to feel protected, to require genuine effort to access. The sheer weight of that whole process, it forces you to actually think about what you're doing.
But then you look at our smartphones today and suddenly that steel door is just it's just gone.
Completely gone.
Yeah, we're looking at a financial landscape that is completely frictionless now. You want money. You just double click the side button on your phone, you hear a pleasant little chime, and boom, you have money.
Which is pretty much the absolute definition of the vanishing pain of paying. I mean, we have literally engineered the friction out of finance.
Which brings us to today's mission. So, welcome to a new deep dive, everyone. We are looking at a massive stack of global research today, ranging from qualitative studies on university students in Indonesia, quantitative surveys out of the Dendeng subdistrict in Surakarta, all the way to plant workers in the Philippines and Generation Z in China.
A lot of ground to cover, yeah.
It is, and it all points to one really terrifying question. Are these explosive new online lending apps a modern miracle or just a digital disaster? In Indonesia, they often refer to these digital loans simply as PINJOL, and the data we're unpacking today reveals how this frictionless finance is fundamentally rewiring our brains and our wallets.
Yeah, the sheer scale of this transformation is just breathtaking. And our goal today is to really help you, the listener, look beyond just the raw numbers. Because while the technology has drastically changed how we borrow human psychology, well, it remains exactly the same. So we need to explore not just what is happening on these glowing screens, but the underlying mechanisms of why you or anyone else might be uniquely susceptible to these digital debt traps.
Okay, let's unpack this. Because imagine your wallet is a leaky bucket, but instead of water, it's digital money, and the hole is your smartphone.
That's a great way to put it.
Thanks. Let's start with the gift aspect, because before we look at the dark side of this leaky bucket, we really have to acknowledge why these platforms have grown so massive in the first place. I mean, they aren't just popping up out of nowhere.
No, not at all. They are filling a very real, very urgent void. We absolutely cannot dismiss the utility they provide. Traditional banking left a massive portion of the global population entirely unbanked or, underbanked.
Yeah.
If you didn't have collateral or a long credit history, you were basically invisible to the financial system.
And the scale of how these apps have stepped in is just staggering. Like, look at the data from the Financial Services Authority in Indonesia, the OJK. They reported outstanding digital loans reaching 27.44 billion rupiah by August 2024.
Wow.
Yeah, that is an absolute tidal wave of micro debt sweeping through the local economy. And when you look at just one province, like Sulawesi Selatan, there are nearly 360,000 active borrowing accounts, heavily dominated by youth.
Hundreds of thousands of accounts in just one province. I mean, it shows a profound level of market penetration.
These companies have figured out exactly how to reach the demographic that traditional banks just completely ignored.
And for many of these young people, the research actually calls these apps an anugerah, which translates to a gift or a lifeline. The barrier to entry is, well, it's basically non-existent.
It really is.
If you're a student, the studies show you often just need to snap a quick picture of your basic national ID card, like a KTP or your student ID, KTM, and that's it.
No awkward interviews with a loan officer?
Yep. No waiting weeks for some bank committee to review your paperwork. The funds are just dispersed directly into your digital wallet in under 24 hours.
And the qualitative studies we reviewed show that these loans are genuinely being used for urgent, legitimate needs at first. Like, imagine a university student who needs to pay tuition by a strict deadline, or they have to buy some ridiculously expensive textbook required for a course.
Right. Or they just need to cover their boarding house rent because the monthly funds from their parents are unexpectedly delayed.
Exactly. In those moments of acute, visceral financial stress, having that frictionless access feels like a miracle. It solves an immediate pain point.
It does. But there is a massive psychological catch here. We looked at a systematic review from 2018 that examined how users perceive these fintech platforms.
Yeah.
And the researchers found something wild.
Oh, yeah, this blew my mind.
Users actually perceive the risk of fintech, so the legal, security, and operational risks, as significantly smaller than the immediate benefits. The immediate relief completely blinds them to the back-end danger.
Wait, I have to push back on this a bit, though. If the risk is perceived as low, just because the app interface is colorful and smooth and, like, user-friendly, aren't we basically just mistaking good UX design for actual financial safety?
That is precisely the illusion. What's fascinating here is how the friction of traditional banking acted as a natural psychological barrier.
Right.
The old way required physical effort. You had to physically travel to a bank branch, you had to dress decently, you had to sit across a desk, look another human being in the eye, justify your financial need, and physically sign stacks of paperwork.
Oh, the paperwork.
Exactly. But all of that friction forces your brain to slow down and consider the consequences. It engages your prefrontal cortex.
It makes the concept of debt feel real. It feels heavy.
Exactly. By removing that friction, apps bypass the brain's alarm system entirely. You aren't handing over physical cash, and you aren't signing a physical contract. You are just tapping a glowing piece of glass. It fundamentally alters your perception of risk and consequence, because the transaction does not hurt psychologically. The user experience designers have essentially weaponized convenience.
So if the friction is gone and the app makes the risk feel practically invisible, what happens when a user's legitimate emergency is over, but the app is still just sitting there on their home screen?
Well, that is the exact moment the transition happens. The slide from necessity to desire is an incredibly slippery slope when there are zero guardrails to stop you.
The sources outline a very rapid shift from the gift to what they call a musibah, a disaster. Users quickly move from borrowing for emergencies to borrowing for pure entertainment.
Yeah, it's a stark pivot.
We're talking online shopping, funding these hedonistic cafe lifestyles, buying luxury goods, and tragically even funding online gambling.
And this isn't an isolated regional phenomenon either. This is a global psychological vulnerability that these platforms are tapping into.
We see this crystal clear in the data from China. Generation Z is actively driving the luxury market there, and they are doing it using installment payments and digital credit. The research points heavily to brand consciousness, social comparison, and just intense peer pressure.
Right. And if we connect this to the bigger picture, we are witnessing the tangible impact of modern materialism. Materialism isn't just, liking nice things. From a psychological standpoint, it is the deeply held belief that acquiring these possessions is the absolute key to happiness and social status.
Status is totally the driving force here. In a quantitative survey from Surakarta high schools we reviewed, the students explicitly identified prestige, or Zhengzi, as a major driver for why people take out these loans.
They're literally borrowing money they do not have at incredibly high interest rates just to impress people on Instagram.
It's wild. And in another study from the Dendang subdistrict, researchers found that 8.4% of all consumptive behavior in that entire community is directly influenced by the mere presence of online loan apps.
8.4%, just because the app exists on their phone.
It is actively fueling impulsive, non-essential spending. It's like giving someone a limitless digital credit card and dropping them in a casino, but the dealer is peer pressure, and the house is constantly sending you targeted social media marketing.
That casino analogy is spot on. The desire for peer recognition and status seeking completely overrides rational financial planning. When you combine high materialism like the need to look successful with a frictionless, instant way to get cash, the human brain will prioritize instant gratification over long-term stability almost every single time.
Because the social reward of posting a photo at an expensive cafe today outweighs the abstract threat of a loan repayment next month.
Exactly. The future consequence isn't real to them yet.
I hear all of this, and my first instinct is to say, well, the solution is obvious. We just need to teach these kids about interest rates, right? Put them in a personal finance class, teach them how to make a spreadsheet, and the problem goes away.
That is the logical assumption that policymakers make all the time. But there's a fascinating paradox buried in the academic data here.
Okay, let's call it the literacy paradox. Because one 2023 study we looked at focused on users of a digital lending app called Danabijak, and they found a critical, almost unbelievable gap.
Yeah, this was eye-opening.
They proved that while financial literacy affects overall financial behavior, it has absolutely no significant effect on a person's financial attitude.
Let the weight of that finding sink in for a second.
Wait, I have to stop you there because that feels totally contradictory to me. Are you telling me that a student who literally aces a personal finance exam on compound interest, someone who fully understands how debt works, will still click borrow on a terrible loan just to buy a pair of shoes. That makes no logical sense.
It makes no logical sense, but it makes perfect emotional sense. We are fundamentally misunderstanding the problem if we think this is just an information deficit. Another piece of research from 2019 highlighted that frequent users of mobile non-cash payments actually tend to be less financially literate, yet they have a much higher tolerance for financial risk.
So, wait, what does this all mean? Does this imply that taking a personal finance class is basically useless if it doesn't fundamentally change our emotional attitude toward money?
Essentially, yes.
Hmm.
Knowledge is completely different from self-control.
Wow.
Think about it. Financial literacy happens in a vacuum, like a quiet classroom. But financial decisions happen in the real world, where your phone is buzzing with a limited time 50% off notification for a brand you love. You can perfectly understand the math behind compounding interest. You can know exactly how much a 30% APR is going to cost you over a year.
You know the math is working against you.
But if your psychological debt attitude, your internal moral and emotional stance on borrowing, approves of taking on debt just to maintain your social status, all that mathematical knowledge is rendered completely useless.
So the dopamine hit wins.
Every time. The dopamine hit at the purchase overrides the prefrontal cortex. It all comes down to willpower. It doesn't matter what you know, it matters what you have the willpower to resist. And these apps are designed by some of the smartest behavioral engineers in the world to systematically break down that willpower.
So what happens when that willpower finally gives out? The illusion of digital convenience shatters, and we move from bad financial habits into devastating real-world consequences. We enter the true debt trap.
This is the point where the system turns predatory.
Yeah. The Indonesian studies describe this visceral, terrifying cycle called gali lubang tulap lubang. It literally translates to digging a hole to fill another hole. Borrowers get trapped taking out new online loans simply to pay off the old ones.
And if we break down the mechanics of that cycle, it is a mathematical death spiral. Let's say you borrow a small amount, maybe $50. Next month, with exorbitant interest, you owe $75.
But you don't have it.
Right. So you open a second app, borrow $100 to pay off the first app, and maybe have a tiny bit left over. Now you owe $150 to the second app. You are no longer borrowing to buy things. You are borrowing simply to survive the debt you already have. The avalanche has started.
And when you inevitably default on that, the collection practices for the illegal, unregulated lenders are just brutal.
They are completely unethical.
Yeah. The research highlights a tactic of public humiliation. When you install these apps, buried in the terms of service is a permission to access your phone's contact list. When you miss a payment, they don't just call you. They pull your contacts and start harassing your friends, your family, your boss, your coworkers. They expose your debt to everyone you know.
It is deliberate psychological warfare. They know they don't have legal standing to collect the debt through a court, so they use the threat of total social destruction to force payment through sheer shame.
It's astounding that this is even structurally possible on a smartphone, and certain populations are incredibly vulnerable to this trap. Look at the specific data from the Philippines included in our sources.
Oh, the public school teachers.
Yes. In just a 2-year span, public school teachers accumulated 319 billion pesos in debt. The study showed they had a 50% higher propensity to borrow than other government employees.
Which is a really crucial data point. Why teachers? Because they have a stable, predictable income that lenders know exists, but that income is often insufficient to cover sudden emergencies, or it's frequently delayed. This makes them prime algorithmic targets for these fictionless loans.
The human toll this takes is devastating. The Surakarta study highlighted a very dark reality. 16% of the respondents personally knew someone where these loans caused severe stress, clinical depression, and even suicide.
It's a massive public health issue at that point.
It really is. And, we also have to mention the complex cultural and moral dimensions at play here. The sources impartially report that within certain communities, these digital loans are viewed with deep religious concern. Specifically, they are seen as containing elements of usury or riba, which is strictly prohibited in Islam.
Right.
Now, obviously, we aren't here to endorse any specific theological viewpoint, but we have to impartially report that this adds a profound layer of internal moral conflict, societal friction, and immense guilt for the borrower. They aren't just battling financial ruin, they are battling spiritual distress.
Yeah, that's an incredibly heavy burden to carry on top of everything else.
So staring down the barrel of all this data, how do we actually fix a systemic failure of this magnitude? I mean, I have to ask the hard question here. Is it entirely the user's fault for lacking discipline and succumbing to lifestyle inflation? Or do the platforms bear the responsibility for utilizing these predatory, frictionless designs?
This raises an important question, right? It's really the defining question of the digital age regarding the balance of responsibility. And it is never purely one or the other.
So it's a mix.
Exactly. The academic studies we're looking at outline several clear, multi-tiered recommendations. First, at the macro level, we need incredibly robust regulatory oversight. Governments have to aggressively hunt down and crush the illegal, unregulated lenders who utilize these extortionate, humiliating collection practices.
But the legal license platforms have a major role to play too, right? They can't just hide behind their user agreements.
Precisely. The legal platforms must be held accountable to strict, enforceable, responsible lending frameworks. We need clear, unhideable disclosures of interest rates. We need hard limits on lending based on verifiable income, not just a quick snapshot of an ID card.
Yeah, that makes sense.
But ultimately, on the micro level, the consumer must also self-regulate. The financial literature consistently suggests a hard, non-negotiable rule. Individuals should never, ever let their total debt installments exceed 30% of their monthly income.
The 30% rule. Okay. But enforcing that on yourself requires that elusive willpower we talked about during the literacy paradox.
It absolutely does. It requires consciously building your own psychological friction where the technology has intentionally removed the physical friction.
Wow. Building your own friction.
Yeah. It means forcing yourself to wait 24 hours before clicking buy. It means actually deleting the app from your home screen so you have to work to find it.
Okay, let's pull back and recap this journey. We started by looking at how digital lending is undeniably a powerful tool. It has revolutionized access to emergency capital for millions of people who were completely shut out of the traditional banking system. That is the gift.
Right.
But we have seen how its frictionless nature, when combined with human materialism, intense social peer pressure, and a fundamental lack of emotional self-control, well, it has turned into a devastating, inescapable debt trap for millions. The disaster.
It's a technology that simply acts as an amplifier for human nature. It amplifies our ability to survive a genuine emergency, yes, but it also violently amplifies our impulses, our desire for status, and our deepest insecurities. So, I want to turn this lens directly to you listening right now.
Yeah.
I want you to genuinely reflect on your own digital spending habits. Think about the last few things you bought on your phone. Did you feel the pain of paying when you double-clicked the side button to authorize the charge, or when you selected a pay later option? Or has the transaction become so incredibly smooth, so seamless, that the money doesn't even feel real anymore?
That is the truly scary part. When the money stops feeling real, the consequences stop feeling real until it's too late. Which leaves me with one final, lingering thought to build on everything we have unpacked today.
Okay, let's hear it.
If financial technology continues on this relentless path, if it continues to make spending money completely invisible and effortless, removing all the steel doors and all the heavy friction, will the concept of personal debt eventually stop being seen as a crisis at all? Will being perpetually in the red just become a permanent accepted subscription fee for simply participating in modern society?
A permanent subscription fee to live your own life.
Now there's a terrifying thought to leave on.
And it brings us right back to the beginning. The vault is wide open. The friction is gone. Thank you for joining us on this deep dive. Stay curious, stay vigilant, and please think critically about those glowing apps sitting right now in your pocket.